Hello, this is Nicole, and this video is about the poor man's covered call. I'm about to show you how options traders are generating consistent monthly income without tying up massive amounts of capital. This one strategy could completely change how you think about income generation in the market. And the best part, you can start with a fraction of what covered calls typically require. The poor man's covered call is an options strategy that offers the benefits of a traditional covered call but with significantly lower capital requirements. Instead of owning 100 shares of stock, which can be expensive, you substitute the stock position with a deep-in-the-money long-term call option, often a LEAPS contract, and simultaneously sell a shorter-term call option against it, collecting premium as income. So how does the poor man's covered call work? Well, here are some general guidelines, and it's important to note that these are guidelines and can be tweaked based on your general preferences and needs. First, you buy a long-term in-the-money call option, which serves as a stock substitute. You purchase a call option with a long time to expiration, often 6 to 12 months, and sometimes even longer. LEAPS contracts are very popular for this. This option should be deep in the money, often with a delta between 0.70 and 0.90 to closely mimic stock ownership. Choosing contracts with lower implied volatility is generally preferable when buying the call option. Next, you sell a short-term call for income generation. You sell a call option with a much shorter expiration, anywhere between 0 DTE to 9 weeks out. The stock price is generally slightly out of the money or at the money, so you maximize premium collection without excessive risk of early assignment. And then you repeat the process. If your short call is going to expire worthless, sell another short-term call, generating additional income, similar to how you would roll a traditional covered call. Let's hop into the tastytrade platform here to demonstrate what we just discussed. I have SPY populated in the chart here, and for the purposes of this demonstration, we're going to assume that I am neutral to mildly bullish in SPY for the upcoming months. I'm going to go to the trade tab here, and I want to first set up a covered call example. So I'm going to populate purchasing 100 shares at the current market price, which would result in a buying power effect of $62,988 debit. And I'm going to open up the September 19, 2025 expiration cycle with 46 days remaining and sell the 645 strike call against those 100 shares. And I'd be collecting a little over $600 to do so. So when I enter that into the trade tab, we can see that the net buying power effect is going to be a $62,373 debit. In the regular cash account, my max profit is $2,129. Theta is positive 11, and the delta is positive 68. Let's contrast this with the poor man's covered call strategy. I'm going to open up the January 15, 2027 expiration cycle with 529 days remaining to use as my long call option expiration. I'm going to do this because if I want to hold that call for a year in order to qualify for long-term capital gains, that means that that call will have 164 days remaining before I can roll it if I want to take advantage of that tax situation. So let's go down and select a deep in the money call option, and I want to stick within the guidelines, and I'm going to select the 490 strike call option with a delta of roughly 80 or 0.80. So I'm going to populate the trade ticket with a buy order to buy the 490 strike call option, and that would result in a debit of $17,164 in the account. And I'm going to turn around and open up the September 19th, 2025 expiration cycle, and we are going to sell the same strike call as we would in the covered call example. So we're going to sell the 645 strike call option against that long call leap. We would collect a little over $600 to do that. So highlighting the trade here, we can see that the buying power effect is significantly less than the traditional covered call by purchasing 100 shares of SPY. It comes in at $16,563. The delta is positive 48. The gamma is negative 1. Theta is positive 5.4. And Vega is positive at 130. So you can see here how much more capital efficient this trade is relative to the traditional covered call situation. Now let's analyze the potential outcomes and payoff. So here I have the same order ticket populated in the Tasty Trade platform here. And just to review, we bought the 490 strike call and sold the 645 strike call in the September 19th expiration. The overall structure has a positive delta of 48, a positive theta of 5.32, and the buying power effect is a $16,563 debit. Now, when I look at the P&L diagram at expiration, I'm a little confused. The profit and loss at expiration is illustrated in this row that I'm highlighting. And you can see that according to this analysis, there's no way to win on this trade. So as the price of SPY increases, we don't make money. In fact, it shows a locked-in loss of a little over $1,000. And as the price of SPY decreases, our losses are capped at the debit paid to enter the trade, which is around $16.6 thousand. So this is very confusing. Why would anyone want to enter into a poor man's covered call if this is the outcome at expiration? So let's go through this. The simple max profit formula is calculated by taking the short call strike minus the long call strike minus the net debit paid. Now this formula has some limitation. This assumes at short call expiration, both options have expired or are exercised with value based purely only on intrinsic value. And here's where the limitation lies. In reality, the long call is still very much alive, often with many months left until its own expiration. If the underlying price is at or even above the short call strike at the short call's expiration, the long call will retain significant extrinsic value or time value in addition to its intrinsic value. So what actually happens at short call expiration is that if the underlying is at or below the short call strike, the short call expires worthless and you keep the premium. Your long call remains open, often with valuable time left until expiration. And at this point, it will have intrinsic value, which is the stock price minus the long call strike if it's in the money, and extrinsic value, since there's still time until the long call expires, especially if volatility remains modest to high or if there is uncertainty about further price movement. So the result is the true profit, if you close the position at this moment, may be much higher than the simple formula thanks to that residual extrinsic value in the long call. And most max profit calculators or formulas ignore this factor because extrinsic value can't be precisely predicted in advance. It varies with volatility, time to expiry, interest rates, and current underlying price. This nuance highlights why advanced traders track option Greeks and market prices dynamically rather than relying solely on static max profit diagrams for complex multi-expiry strategies like the poor man's covered call. So now that we walked through that, I want to show you a workaround in the Thinkorswim trading platform. I have SPY populated in the trade tab, and we are going to populate the same trade that we just looked at in the Tasty Trade platform. So we're going to buy the 490 strike call option in the January 15th, 2027 expiry. And we are going to open up the September 19th, 2025 expiry, where we are going to sell the 645 strike call option against that 490 strike call option. I'm going to scroll down here, and we can collect just over $600 for that trade. Prices are moving around a little, but not dramatically. And we're going to analyze this trade in the trade tab in Thinkorswim. And you can see here I have the poor man's covered call spread entered as a whole, as well as each individual piece of the poor man's covered call entered above that. And I deselected that, so we're just looking at the spread as a whole here. And the expiration is September 19th, so that's the date I'm going to select so that we can see what this trade would do at expiration. And of course, the profit and loss for the day is going to equal the profit and loss open because it is at expiration. And here's how we can see what this trade might look like at expiration. given assumptions for SPY price. And in this case, it's up and down in 3% increments. And if we want to look at the individual legs and their performance, we can go ahead and select those and see how they fit together. And that might come in handy when you're analyzing rolls and that kind of thing. So if you want to look at rolling your calls or establishing a new short call, you may want to look at the legs individually as the trade progresses. And here the max loss is just equal to the cost of the long call option minus the premium received from the short call. So pretty straightforward there. So what are the advantages of the poor man's covered call? Well, lower capital requirements. You do not need to buy 100 shares of the stock. Next is synthetic stock exposure. The long in the money call mimics stock ownership. Next is ongoing premium income. The short calls provide regular premium inflow, potentially offsetting the cost of the long call. And flexibility. You may roll your short call, adjust strikes and expirations, or close the strategy at any time. So what are the risks and limitations? Well, you'll lose if the stock drops. If the stock price declines sharply, your long call loses value, and the premium from the short calls might not offset your losses. Profit is capped since your short call limits your upside. If the stock surges, your max profit is capped at the short call strike. Next is assignment risk. If the stock moves sharply above your short call strike and you don't do anything to manage that, you may be assigned, which can lead to complex adjustments. And long call theta. The long call loses value over time, though slower than the short-dated options due to its longer expiry. And here I have a chart just comparing the poor man's covered call versus the covered call versus cash secured puts. And you can go ahead and pause the video and go through that at your leisure. So let's wrap up with some key takeaways. The poor man's covered call is best suited for moderately bullish stocks or ETFs. It uses options to simulate a covered call, allowing income generation with a fraction of the capital required by traditional covered calls. Monitor both option legs, understand assignment risks, and be prepared to adjust or roll positions as needed. This is ideal for investors seeking income and capital efficiency, but who accept the capped upside and risks inherent in option strategies. And this strategy is widely used by options traders seeking capital efficiency in income generation. A well-managed poor man's covered call can be a highly effective, lower capital alternative to the classic covered call, offering repeatable premium capture and risk control. It rewards active monitoring and an understanding of both option pricing and market forces. For more information on practical trade setup, live management, adjustment scenarios, and comparing the poor man's covered call to related strategies, be sure to like, share, and subscribe to the channel. As always, thanks for listening and be awesome.